Hi, and thank you for joining us today. My name is Jimmy Connor, and I'm with Bloor Street Capital, which is a corporate access firm based in the city of Toronto. Today, I have the pleasure of introducing you to Peter Grosskopf. Peter is the CEO of Sprott Inc., and Sprott is the world's largest asset manager, which is focused exclusively on the precious metals market. Sprott's AUM is $18 billion, and therefore Peter can offer us a very unique perspective as to what he's seeing within the precious metals market. Peter, I want to thank you very much for joining us today.
Well, thanks for having me, Jimmy.
So maybe you can just give us some background on Sprott, when the company was founded, who founded the company, and how its investment style has changed in the last 10 or 20 years.
Sure. It was founded way back in 1981, which makes it one of the longest standing firms in the resource sector. Eric Sprott was known as a junior stock picker who had an incredible track record at identifying high growth companies. It wasn't just in resources, but over time he became more and more convinced that the economy and the financial system was getting too levered. So he really started focusing on gold by the year 2000. The firm was growing. When I came over in 2010, we diversified into bullion funds, we diversified into private lending and equity, and we added some brokerage activities, re-added them. So it's become a soup to nuts powerhouse in precious metals, and it took a long time to build that foundation.
And so just to clarify, Eric Sprott is no longer involved with the company?
No, he's a client, and he's a co-investor in a lot of deals that we do, but he runs his own family office very successfully, and he has no conflicts doing it that way.
Right. So anytime we read about Eric Sprott making investments in various companies, that's all through his personal money?
For the most part, except when we're acting together.
Can you just tell us what the various divisions are under the Sprott umbrella?
Sure. It's broken down between public investing on one side and private on the other. The public investing is comprised of bullion funds, which are on exchange traded bullion, and also public equity funds. And then on the private side, we have private lending, some private equity, and we have our own investments, our balance sheet.
So Peter, it's been a great year for both gold and silver. What is Sprott's AUM now, and how has it grown since Jan 1 of 2020?
I would say that the growth has been pretty spectacular this year, in the order of 70% or so. And that's been mostly money coming in to the bullion side of the firm. That's where the large flows have been across the entire industry, and we're no exception. We also have growing private funds as they take down more of their commitments. So it's all kind of synergistic. And then lastly, we've got great performance on the equity side. So our AUM's grown rapidly, and no surprise, it's a bullish environment for precious metals.
So Peter, I'm surprised to hear you say most of the money's flowing into the bullion. I'm just surprised it's not going into the equities, because that's where you can get the biggest move.
Right. Well, equity funds, sector funds specifically, have gotten a lot less popular in the overall fund management area. Investors are generally investing in really broad-based kind of wrap programs and retirement savings programs. They're also investing in ETFs, but for the most part, haven't come back to putting money into specific sectors by way of mutual funds. So I think that accounts for some of the difference.
And the money that you've seen flow into Sprott this year, in both the bullion and also the equity portfolios, how would you describe the profile of those investors? Are they retail, institutional, or are they Canadians, Americans, Europeans?
Depends on the product, and I would say we have a good cross section of most of those. On the bullion side, it's both institutions and retail. On the equity side, it's more retail than institutions. And on the private investing side, it's more institutions than retail. North America is, specifically the US, is the largest flow area for us. I think Europe would be, and the Middle East would be second.
What percent of U.S. portfolio managers have some weighting in precious metals?
Well, I'll take it back to your last question, which was why are equities lagging on the flow side? I think that percentage is still quite small, both on the retail and the institutional side. I'm going to guess that 50% of investors have never allocated to gold. And the other 50% are lagging the market weight of what precious metals would represent in a balanced portfolio these days. So the entire weighting has yet to react to the precious metal bull market.
And do you think that's just because of competition in other asset classes? Nasdaq is currently up 25%. It was up 40% on the year.
Yeah, I do. And there's still some headwinds that gold is facing as an asset class. It used to be more of a fringe asset class that was used by hedge funds and global macro traders. And there were the retail gold bugs. I think just recently it's entered the mainstream where it's become a must-have portfolio diversification asset. And some investors have made that leap and others have just lagged and have not given it proper credit.
Peter, recently, a couple of generalist investors out of the U.S. have made investments into the precious metals market. The first one being Berkshire Hathaway. They've invested $500 million plus into Barrick Gold, and the Ohio Pension Fund also announced that they were going to allocate 5% of their $16 billion fund toward precious metals or gold specifically. What are your thoughts on this? Are you seeing a lot more generalists getting involved in the precious metals market?
Yeah, I think it's the tip of the iceberg. The generalists had thought of gold as a fringe asset going back in time. They were either gold bugs or they were hedge funds that were able to trade it quickly. I think now investors see it and starting to see it as a mandatory portfolio management asset, a diversification asset, more attractive in many ways than US Treasuries. Because it does offer, in our opinion anyway, a lower risk profile. And I think that those are important moves by leading investors to allocate properly to gold, whether it's 3%, 5%. Most investors are just looking at it now. So I think we're in the very early stages of seeing it being adopted.
Why should an investor invest in Sprott Inc. or a Sprott product versus investing directly into a mining stock or into another ETF like GLD, for example?
Right. Well, other than a commercial, I would say we strongly believe that our products in every case have been devised to be more investor friendly. So for instance, our physical products are 100% backed by gold stored at the Canadian Mint. Investors, if they are large enough, can roll a truck and pick the gold up. So we think the finest surety of storage available. We think we give investors a fair package in terms of education, transparency, and that our products deliver what they should to those investors. In terms of Sprott Inc., we're a unique proposition, as we previously mentioned. We're closer to a royalty company than anything else. I think we're an asset management royalty company, and it's about having high margins and being able to weather downturns and provide good leverage and a good return and some upside through performance fees. So we think either way, we've got something for an investor that wants to look at the sector.
Sprott Inc. has acquired a few companies over the last few years, with the most recent one being Tocqueville in January of this year. Do you plan on making more acquisitions going forward?
Yeah, that's also an interesting question. I would answer it by saying there are some niche firms globally who we think have either pockets of unique talent or customer client base that we would covet. We can readily admit that we're not big enough to be the best in every jurisdiction. So we'd look internationally to either some distribution deals or joint ventures or partnerships, or to pick up a local firm that could add to our global coverage.
Peter, where do you see Sprott going in 5 years from now? Where would you like to see it?
I think we can continue to broaden the firm a little geographically, getting into some new client markets and also some new areas. We haven't been big in private equity in the past, for instance. And each of our other investment divisions is still able to handle a lot more clients and a lot more assets. So with this growth bullish market condition, we don't see any reason why it's going to slow down. We think we could be a $50 billion firm in 5 years.
Stock markets are making all-time highs. The Nasdaq is currently up 25% on the year. It was up 40%, but it's pulled back here in the last couple of weeks. Apple is up 50% on the year. Amazon's up 60% on the year. And then, of course, I can't forget about Tesla. It's up 400% on the year.
Right.
What are your views on these valuations? And does this period in the financial markets remind you of another time period?
Well, it's clear that the Fed and loose money policies have created an environment where risk taking is being encouraged. I think the growth has existed with those companies, so now the growth is just being priced that much higher. We do think it's a bit of a bubble and that the real economy is lagging those growth situations considerably. Don't know when it will end. It can go on for a long time. I would note that even in that kind of an environment, gold is giving Nasdaq a run for its money. So there's just as many people that are playing the hedge that are playing the growth. And no, it doesn't remind me exactly of any other time in history. And that's because I don't think there's ever been such absolute focus on coordinated, massive, globally instituted money printing and stimulation. It's all happening at the same time globally, and the markets have become addicted to it. We would go to the extent to say there is no more free market anymore. This is a market that's been significantly influenced by government policy.
So having said all that, what does this mean for the price of gold, in your opinion?
Well, I think the price of gold will continue to do well, and for one principal reason, and that is that there's $100 trillion in credit market instruments that are priced off sovereign yields that are now anchored at zero. And that just doesn't make any sense. Those credit markets have downside due to inflation, which the Fed has now gone and told us that they are going to try and promote for the next 3 years. So we think gold is a very compelling portfolio hedge to sovereign bonds, and that the movements into gold are just getting started because that's a huge market. It only takes a couple of percent to really impact the gold market.
And we touched on this a little bit earlier, but once again, it comes down to competition in various asset classes competing for that capital. But do you think if we get a pullback in the S&P and the Nasdaq, that you might get a large move in the price of gold and also gold equities?
Yeah, I think that's probably one of the tests that it will have is when markets themselves, the equity markets, get tested. How does gold react, and can gold do what it did last time, which is survive what really amounted to a margin call and do much better out the back of it? We think that will be the case, and we think it'll be the case because there'll be even more government sponsorship and intervention, and that with that money printing comes a need to hedge against the money printing, hedge your purchasing power by buying gold.
So we've talked a lot about gold. What are your thoughts on silver?
So silver is a much smaller market, and although it's traditionally balanced annually by industrial supply and demand, when investors are buying silver, it can be accumulated at a much more vicious path than gold can, pace, I should say, than gold can. And in this environment, with gold being accumulated, silver has, I think, more upside than gold. It's a smaller market, can be squeezed quicker.
And of course, we have to talk about the US dollar. What are your views on the US dollar and by extension interest rates?
Well, the US dollar's had a rocky few months here, and that's been because the Fed has been very dovish. I think that it perhaps can have a bit of a rally here. It's quite oversold on technical basis, but I don't think that makes much difference in the long run. The world, the U.S., the markets cannot afford a stronger U.S. dollar. So I think it has to be managed in position to other fiat currencies to balance the global economy. I think it's range bound, and that it's probably not going to see a lot of strength either.
What are going to be the drivers for gold and silver going forward here in the coming months? What's going to take them higher?
So in both cases, I think that's a healthy consolidation. The technicals had become a bit overextended. You know, you had so many days of trading in which gold had acted positively every day, no matter what was happening. The sentiment indicators were a bit hot, and the funds flow and the commitment of traders was a bit long. So this is healthy for gold. I see that over the next year, there's no reason that gold can't make it into the 2000s and maybe even, you know, breach 2,300. And that would just be putting a percentage on the size of the market now and how much liquidity is moving into gold and how it will do compared to other asset classes. So I think it's locked to have a good year next year as well.
And what are your views on inflation? Do you think we're going to have inflation, or are we going to have a period of deflation?
Well, in the short term, I think we've got a big hill to climb before we get inflation. The labor market's still fairly slack. The virus still has not been solved. The economy's got a lot of extra capacity, and just don't see with this amount of turmoil that you're going to get a very strong condition for inflation. My esteemed colleague John Hathaway has done a lot of work on this, and what he believes is that for inflation to really kick in, the Federal Reserve debts have to become legal tender, and that'll just give them the capacity to have an unbelievable amount of money printing and bond buying that would go on. So he believes that'll be the harbinger of future inflation. I do think eventually it will come. So long term, there's been too much money supply that's been created, and we've already seen certain parts of the asset markets inflate rapidly. It'll just be a lag before it hits Main Street.
Peter, what advice would you give a young investor on investing in the mining sector?
I think to make a good long-term return on the mining sector, you have to pay attention to a few things. First of all, you have to do your homework on the asset. Secondly, it makes all the difference in the world if you have a team that has the experience and credibility to make investors money and are aligned with investors that own a share position. And thirdly, you've got to be a bit counter-cyclical about it. You can't just buy stocks when they're running in our sector. You have to wait until a time when nobody else is really that interested and start picking away. Whatever your rule for finding the bottom is, maybe you wait for a technical signal, but you have to try and act counter-cyclically, and you also have to sell counter-cyclically.
Peter, if you could have a second career, something outside of the mining industry, something outside of the investment industry, what would it be?
Yeah, well, it wouldn't be as boring as just being in the finance business. I think I would definitely want to be a rock star. I've been reading Keith Richards' autobiography, Life, and that is the life. You know, those guys in rock and roll. That would be a very interesting way to have a career.
Yeah, I don't think anybody would dispute that or argue with you on that point. And do you play any instruments?
Yeah, I started in piano. I actually played in a high school jazz band. I played the trombone, and more recently I picked up guitar in university, and probably play more guitar than anything else these days.
Oh, wow, good for you. Do you ever play with Kevin O'Leary?
No, I'm not good enough to play in any of those bands. I know there's a few finance industry bands, and I'm just a campfire specialist.
Peter, if you could give one piece of advice to someone starting out their career, regardless of the sector or the industry, what would it be?
Well, it would be to not follow the crowd, follow your heart. It's really about what means something to you from a passion standpoint, and also to look ahead. You can't just look at what's happening with the world now to understand where you could do well. You have to figure out where it's going. And look, there's been lots of careers and businesses that have been made during this incredibly difficult year. And the human race has an incredible ability to reinvent itself. You just need to be part of the reinvention process. Don't look behind you in terms of things that other people have done in the past to succeed.
Peter, thank you very much for taking the time today. That was a very informative discussion. I do appreciate it.
Well, it was a pleasure to talk to you today, Jimmy, and hope you have a good one as well.